In this short video, I want to cover one of the most widely quoted ratios by analysts, the press and so on, but one that investors are often a little uncertain about because it sounds a bit meaty. It's EV, enterprise value to EBITDA, earnings before interest, tax, depreciation, amortization. Now before you switch off the video thinking what on earth you're on about, this is an alternative to the well-known PE ratio. But how good an alternative is it and how much attention should you pay? It's one of those ones that's at least worth having some idea how it's put together so that if it's quoted at you, you've got some idea of what it might be trying to tell you. Now, finding stock bargains, that's what it's all about basically. It's about how do I find cheap stocks or how do I identify expensive stocks that I might want to get rid of. So value investors and EV/EBITDA, like the PE ratio, is a value investor's tool. It's all about finding good shares at cheap prices. So hopefully this number will help us do exactly that. Traditional measures of value include the PE ratio and the price to book ratio, but people who favour this one, this is a slightly monster sounding one, reckon those ratios, in particular the PE ratio, are faulty, don't work in certain circumstances. I'll show you what I mean by that just now. Another ratio is heavily used by analysts. Unfortunately, it's not automatically published for you, so you have to do a bit of digging around or homework or ask the question, what is it? But nonetheless, it is heavily used by private equity houses, analysts and the like. Fans claim it's a more reliable guide to value. Now they would, so you have to be careful when you apply it. Okay, so here we go. Quick tour. What is this thing that's become a kind of, a contender to the PE ratio's crown, if you like? Okay, the PE ratio problem is what? Let's take a business that's got 100 million of assets, funded 100 million of equity. So the assets are entirely funded by shareholders, and compare it to another one where 100 million of assets, that's assets at the top, that's the value of the business, if you like, what it uses to operate with, are funded 90 million of debt and 10 million of equity. So you've got a business that's got no debt, no gearing, and a business that's quite highly geared. So 90% of its funding is debt. And now let's just look at a few very simple numbers. I'm going to go through these quickly because most people don't want to know what this is all about at the end, but you'll just see the problem with the PE ratio here. If operating profit for both businesses, the no debt business on the left and the debt business on the right, is 10 million. Then we've got interest to pay. Now this business here doesn't have to worry about that because there is no debt. But if you're carrying 90 million of debt in there and I've made up a rate, so that's 5% interest, that's going to cost you 4.5 million. That's simply taking 5% of 90 million. That's going to cost you that every year. This is an annual statement, don't forget on the right. Tax at 30%. Well, if you're making a profit of 10 million, carrying no debt, there's no interest, 30%, I've made that rate up. For my purposes, give you a tax bill of 3 million and a profit after tax of 7. Okay, the advantage of carrying debt is you do get tax relief on it. So what I've done there is to say, to work out the tax bill, 10 million minus 4.5 times 30% is 1.65 million. There's your tax charge. So 10 million minus that is 3.85. Now the numbers are less important than what's about to happen next, to be honest. If you didn't follow them, it's not a disaster, but they're fairly straightforward, hopefully. If you then calculate PE ratios for these two companies, you get different results because a PE ratio would compare, conventional PE ratio, the market capitalization of the business to profits available to shareholders, price to earnings. And 100 million as a multiple of 7 is around 14 times. Right? Whereas the company with debt, what you'd be comparing is its market capitalization, I cover PE ratios in other videos by the way, quick reminder coming up, to the profits left once interest has been paid, 3.85. So my point is you get a much lower PE ratio. 14 times there, only 2.6 times there. Yet, the businesses are the same size, same asset base, and they're generating the same level of operating profit from the heart of their business. So it's a bit weird. Yet they're given different ratings by one of the most famous ratios in the market. Well, there's your problem. Some people say the problem with the PE ratio is it penalises companies that carry a lot of debt. Now, other people would say it reflects the fact that they're riskier. So this company's cheaper on a PE ratio because it is carrying more debt. But nonetheless, maybe you can't tell that just from a snapshot on two PE ratios. So how are we going to solve that problem? How are we going to sort of even things up? And that's where EVEBITDA comes in. Now, just to move that on, a P ratio refresher. P is market capitalization or share price divided by profit after tax or earnings per share. All right, and we're going to amend that ratio to get our new one. We're going to amend it slightly by changing that and changing that. So, problems. Market capitalization, first of all, doesn't reflect debt, as I just mentioned in the previous example, and could mislead where a firm carries a lot of debt or a lot of cash. It can alter or distort the PE ratio. Profit after tax, which is the other side of a PE ratio, it's the E if you like, it's a long way from cash flow for some people's liking, and it reflects two very subjective costs. It reflects the capital costs of running your fixed assets, depreciation and amortization, which are judgments made by the directors as to how long their operating assets will last. And for some analysts, that's also a bit misleading. So EV is going to try and solve the problems over here, and EBITDA, which is basically a revised profit number, EBIT or EBITDA, is going to try and solve the problems on the right. How? Well, what we're going to do is substitute market capitalization for the whole value of the business, almost what a predator would pay for it. Because if you're a predator buying a business, you can't just buy a bit of it, you've got to buy the equity and the debt, the whole asset base. So let's put in market capitalization plus debt less any surplus cash. All right, on the basis you don't pay for cash. Cash is cash. All right. So that'll take account of any debt or cash on the balance sheet, and will hopefully get us closer to the price that a predator would actually pay in the real world. They're not going to just buy one chunk of the business. EBITDA, let's take earnings before any interest costs, so that takes out the difference in financing structures, if you like. Let's take out tax, because that can distort profit figures as well, and take out any cost associated with running fixed assets, any subjective cost, depreciation and amortization. So we get the return to all providers of finance, and we're going to compare that to the total value, enterprise value of the business. Now, the new number, therefore, is enterprise value as a multiple of EBITDA. So just as a PE ratio could give you the answer 10, so could this. So if enterprise value were 100 million for argument's sake, and EBITDA happened to be 10 million, then you get a multiple. People would say the EV/EBITDA multiple is 10 times. Low tends to mean the stock is either not well rated or cheap, depending on your perspective. High, highly rated by the market, and or expensive, depending on your perspective. So interpretation very much like a PE ratio. Now, is it any good? There are opposing views on EV/EBITDA. It's a contentious ratio, even though it's quite widely used. James O'Shaughnessy, What Works on Wall Street, famous study of US stock market returns 64 to 2009, said, yeah, it's brilliant because look, investing on a PE basis, you get a 16.3% annual return. Applying EV/EBITDA as your stock screen for value, you get 16.6%. Now, it may not look like a big gap, but over that period, that's a significant absolute difference in returns. But Charlie Munger, Warren Buffett's right-hand man, said every time you see the word EBITDA, that's the earnings number adjusted for stuff that you want to take out, substitute it where you can see what he substituted it with right there. Don't need to necessarily announce it in a video. So some people love it, some people hate it. It's popular in the private equity world, which instantly leads some people to be a bit suspicious because private equity is about growing businesses rapidly and then selling them on. Is that an investing style that applies universally? Possibly not. And it's not widely published. You can't just pick it up like a PE ratio. If you open the FT, you won't just find EV/EBITDA there in front of you. So let's just run those numbers again as a final point. If I take my two businesses, 100 million of assets funded entirely by equity and 100 million funded 90% with debt, and do a quick comparison on an EV/EBITDA basis this time, what do we find? Same numbers for profit, same interest bill, same tax charge, same profit after tax. But PE ratios would still be the same. 14 times on the left, 2.6 times on the right. So this company looks either cheaper or it's been penalised in some way. But if we were to look at return on equity, we find that the company on the right is actually generating a 38% return, 3.85 million over 10 million, versus 7%, that's 7 over 100. So there's a conundrum for a start. There's a how on earth can that PE ratio be right if this business is generating so much more value for shareholders? And EV/EBITDA would say, well, let's solve that. Because if we look at enterprise value, we'll be looking at the whole value of each business, debt plus equity, so that's 100 million in both cases, and comparing it to the profit number before interest, before tax, and I've ignored depreciation and amortization for this example. So in other words, on an EV to EBIT basis, because there's no DAR, you get 10 in both cases. And some analysts would say, that's fair enough, because they're the same size, right? They're generating the same level of profit, they're just financed differently, but why should a company that carries a lot of debt be penalised for that? And the answer, if you're Charlie Munger, is because it makes that company much riskier, arguably. That was fairly fast. Any questions? To the usual place.